Motley Fool Answers. I'm Alison Southwick, and I'm joined as always by Robert Brokamp, personal finance expert here at the Motley Fool. Hello, bro.
Hello, Alison.
In this week's episode, market volatility was just all the rage this last week, and so we have Morgan Housel here to soothe your rattled soul. And bro is going to talk about something. I don't know what it's going to be. It's a surprise for everyone. All that and more on this week's episode of Motley Fool Answers. So, bro, what's up?
Retirement accounts are up.
Yay! That sounds like good news.
It is good news. And we know this because Fidelity has released recently its quarterly analysis of the more than 30 million IRAs, 401ks, and other retirement accounts that investors have with Fidelity. So it's a pretty good survey of what people have and how they're doing. And this latest report is particularly interesting because not only do they provide the most recent numbers as of the end of the first quarter of this year, so March of this year, but they provide the numbers from March from 10 years ago, which was right when the stock market bottomed after the Great Recession. So we not only get to see, we've talked before about how well the stock market has done since then, but this report gives us an idea how much better retirement savers are doing since then. So let's dig into 6 questions about the average retirement saver that this report answers. Number 1, how big is it? And of course, I'm talking about 401k account balances reaching $103,700, an all-time high. It's up 8% since the end of 2018, so that first quarter. And to be honest, I was a little surprised at that. I thought it'd be more because in the first quarter of this year, the S&P 500 was up almost 14%. Plus, people are putting more money into their accounts. But I think the bottom line is, of course, that not everyone is invested completely in the stock market, which is a topic we'll hit on a little later. So how does that $103,700 compared to a decade ago? $46,000 was how much the average person had in their 401k.
Wow, okay.
So it's more than doubled.
Okay.
But again, that's good. But again, you might have expected more given how well the stock market has done. But 401ks are tricky because these averages could include everyone who's been there for 30 years versus and someone who's only been there for 6 months. So they very helpfully broke out the numbers of the account balances based on what generation you're a part of, as well as for numbers for someone who's actually been participating in the same account for a decade. So if you look at someone who's been participating in the same account for a decade, the average balance is $297,000. versus just $52,000 a decade ago.
Okay.
So it's up 466%.
Not too shabby.
Very good. Very impressive. And just in case you're curious, the average balance for someone who's been investing for 10 years, millennials, $129,000, Gen X, $268,000, boomers, $357,000, which is good news, especially when you hear stats about the average amount that someone has, especially at that age as they're about to retire. For those who are participating in a 401k and have been saving, they're doing pretty well. All right, so that's how much people have saved if they're actually saving. But what about question number 2? What percentage of employees are actually participating in a 401k? And the answer to this really depends on whether or not the 401k automatically enrolls people or not. If the plan automatically enrolls you, just once you join the company, you're put in the 401k, 88% of employees participate. If they don't, 52%.
Wow. Big
difference. Clearly, people need a nudge to sign up for the 401k. And we hear about the retirement crisis and how people haven't saved enough. Obviously, one answer is just to make sure everyone gets put into the 401k. Once you're in there, only 9% of people then change their mind and say, no, I don't want to be in there. Once you're put in the 401k, the vast majority of people stay in it.
Well, we're only talking about the people in this country who even have, it's a slice of people who actually have access to a 401k. Think of all the people who don't even have access to a 401k, who have to go through so many more hoops to save money for retirement. It's a huge barrier to entry.
It really is. It's around a little bit more than half of employees are covered by a work plan, 401k,
whether it's a pension
or something like that, right? Which means almost half don't. Now you can still choose an IRA, but IRAs have lower contribution limits. Also, you can set up a solo 401k if you're self-employed, but that's kind of a hassle. So having a job with a work plan is a huge, huge benefit. So one thing also that is higher is that the amount you're automatically enrolled in. So a little less than half are automatically enrolling people at 4% or higher, which means that more than half of the employers are automatically enrolling people at less than 4%, which in my opinion is too low. I think you can get away with automatically enrolling people and having them contribute more than that. If they don't like it, they can always change it. But I think that's also another way to be helpful. So number 3, how much are people saving? So the average employee is deferring 8.8% to their 401k. Employers are putting another average 4.7% for a total of 13.5%. Another all-time high, which is pretty good. We've talked before about how I think really people should be shooting for 15%. And that's if you're starting in your 20s, maybe even your 30s. So
Before the match.
No, the match included.
Including the match. Okay.
Included. And that's part of what we've done here at the Fool. If you contribute 9, you get 6 for that 15. So people probably should be saving a little bit more, but still, this is pretty good news.
Yeah. And now I need to go hop into Namely and double check how much I'm contributing to our 401k.
So question number 4, how are they investing? And this gets back to that question of asset allocation, things like that. The report really celebrated the fact that people are more diversified. So for example, they had this stat saying only 10% of the people are either 100% in stocks or 0% in stocks. So all in or all out. Compared to 2009, it was 25% of people who were all in or all out. Now, me personally, I think as a relatively aggressive investor and a typical Motley Fool, I'm actually fine being all stocks. So I'm not sure this is a great thing necessarily to celebrate, especially since stocks have done so well over the last decade. But I do think generally diversification is important. And the reason people are becoming more diverse is the use of target date funds. Target date fund is just a single mutual fund that owns other mutual funds, mix of stocks, bonds, cash, international stocks, U.S. stocks. And currently, 52% of people with a 401k at Fidelity are exclusively invested in a target date fund, compared to just 16% in 2009. And this also goes back to the automatic enrollment, because for plans that automatically enroll employees, 90% of those people are being enrolled in a target date fund. I think it's a great solution, especially for the hands-off investor. But even the most aggressive allocations do have some cash and bonds. So if you are a more aggressive investor, you might want to fiddle with that a little bit.
Yeah, I'm in a target date fund, and I was thinking I need to maybe start contributing to a farther out target date just to maybe get a little bit more aggressive.
Yeah. And it is interesting because we just recently on the 401k committee here at the Fool evaluated our target date funds, and we felt that the ones that we had were too conservative generally, and we've replaced them with another set that are more aggressive generally, but they get really conservative right before retirement, which some people think is good, but it's a debate about exactly what they call the glide path should be. So it is pretty complicated. Again, target date funds I think are generally good, but you do want to make sure you have the right ones. All right, two more things from the report. Number 5, are retiree wannabes choosing the Roth or the traditional? And the answer for 401ks is overwhelmingly the traditional. Almost 90% of people are going with traditional. Only 11% are going with Roth. But interestingly, when you look at IRAs, it's different. With the IRAs, 52% are Roth. So what people are doing is they're using the traditional for the 401k, but then opening a Roth IRA, which I think makes a ton of sense. I did this for many years. You get the tax diversification and having a little bit of both. Also, generally speaking, people are more aggressive in their IRAs because they can buy individual stocks and things like that. And if you want one account to grow the most, it's the Roth IRA because the distributions are tax-free. You want your tax-free account to grow the most. So I thought that was pretty interesting. They also had a stat in here that I already said the average 401k account for $103,000, the average IRA $107,000. But when you look at the average total of people who have both 401ks and IRAs with Fidelity, the total is over $300,000. And I actually sent them a question, like, why is it that the combined is so much higher than the separate? And they said the people with IRAs and 401ks are much more engaged and they save more. They also tend to be a little bit older. But I certainly think it makes a lot of sense that if you have the money to invest in both. And finally, number 6, what made me cry the most? Well, they had a stat on what people do with their 401ks when they leave their job. We've talked about this before. 36% of the people cash out their 401k. They don't roll it over to their next 401k. They don't roll it over to an IRA. They take the money, which means they pay taxes. They pay penalties if they're not 59.5, and they miss out on all that future growth. Also makes me sad because I know a lot of people are doing this for reasons they have no choice over. They might have medical bills or something like that, and I certainly have sympathy for that. But please, 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 if you're ever thinking of doing this and you don't need the money, roll it over to an IRA. You're going to save yourself a lot of current bills in terms of taxes and penalties, but you're going to be very grateful you kept that money invested when you retire. And that, Alison, is what's up.
Dow bleeds overnight on 50% chance of Trump trade deal failure. Money managers are bracing for a sharp fall. And some guy on Twitter was copying Enter Sandman by saying, exit light, enter night, take my hand, we're down 600 points again. These are just some of the high-low lights from the last week of insane volatility. And at the time of recording this, the S&P has had a wild ride. It's up at about I guess it's at about 2,800, up 300 points year to date, but down about 100 from its high. And as you're listening to this, I can only guess what sort of dystopian economic wonder hell you're living in 3 days later. So joining us in the studio today, actually just me, is Morgan Housel, who's going to offer up his calming words and advice.
That was so dramatic. You did a good job setting the scene.
I know, it's tense.
Of how not to react to these news stories.
Oh, it's tense. Like, how can you do it? Because I think about people like my dad who watches the news. He doesn't necessarily care about finance. But when you just casually watch the news and then suddenly you see headlines like, set your hair on fire, the market's down 300 points. Then my dad's like, oh, well, it sounds like I should set my hair on fire. They say the market's, but then when you're like, well, 300 points really isn't that much these days, blah, 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 blah.
There's this thing, like every time the Dow falls at least 500 points, CNBC does a segment called Markets in Turmoil. And there's always this thing like on Twitter where it's like, okay, we're going to do this Markets in Turmoil segment again. And it's just like an indicator of the panic that goes on. It's almost like this song and dance that goes on when the market falls. And Alison, how many times do you think, so I first joined the Fool in 2007. How many times do you think you and I have done a podcast before?
Oh my gosh.
To talk about market volatility? 30? Let's say.
We've done it a few times.
15? A lot over the years.
It's time well spent.
But I think it's interesting that this kind of volatility, these kind of declines happen so frequently. But every time it happens, there is this reaction within headlines, within how investors react. And it's not a bad thing. It's not a criticism of how the media reacts. I just think it's an inherent part of investing that these declines, no matter how frequent they are, even if the kind of declines that we've had in the last month is the kind of thing that we've had 3 or 4 times a year going back forever, it's still going to feel way worse than it should when it happens. And I always say, like, yeah, the Dow fell, 1,000 points last week, which is the first time it's happened since the last 1,000-point decline that you don't remember anymore.
Yeah.
These kind of things happen all the time. And I think the proper framing for big volatility like this is, there's a cost of admission for big market returns. If you want big returns over the long term, those don't come for free. You have to pay a price to get those. And the cost of admission for markets is, of course, volatility. And there's 2 ways to look at that. You can look at it as a fee or a fine. A fee is you're paying the cost of admission, and it's a good trade. You're paying the cost, but you're getting something great in return. A fine is you're not supposed to pay that. You're not supposed to get fined. You're supposed to avoid fines, so you try to avoid it. And I think viewing volatility as a fee instead of a fine is the proper way to think about it. This is the cost that you're paying to do really well over time, but it's not a fine. You're not in trouble. You didn't do anything wrong. You don't have to avoid this. You don't have to feel guilty for dealing with this volatility. It's not a fine. It's just a fee that you're paying. You're just getting the bill. You're getting your quarterly bill to get long-term returns over time. That's what these volatility kind of spikes that we deal with every quarter, I think, mean for investors.
All right, well, let's talk specifically about the recent market volatility. I did a little bit of my homework. I think it's because trade war, retail sales, like what's causing the recent market volatility?
I think whenever there's an attempt to say the market fell because of X, it's a dangerous path that you're going down. Sometimes it can be fairly obvious. The best example is in 2008, during the financial crisis, Congress voted down the bank bailout, and within seconds, the Dow went from up 500 points to down 900 points. Like that, you can say, okay, the market fell because of X. Yeah. Most of the time, I think it's very difficult to pinpoint why the market's falling. If we want to say that the market you've had volatility in the last week because of the trade wars and developments between China and the United States, I think that makes a lot of sense. And two things come from that. One is that when the market has done very well, as it has over the last 10 years, and valuations are high, things are just much more sensitive to even a little bit of bad news. So even if there's a tiny news story that people didn't expect, investors didn't expect, even the tiniest sliver of bad news can send the market tumbling. That's not the case if you go back to March of 2009 when valuations were low. And even though bad news was coming in day after day, unemployment was high, people were being laid off, there's bad news everywhere, the market was surging day after day. So it's just how markets react to news is just in context of their current valuations, and valuations are really high right now. The other point is that most recessions, most big economic events are not economic events. They're not financial events. They're political events. And I think that's hard for investors who say like, oh, I like investing, but I'm not into politics. I think that's a fine mindset, but most recessions are political events. And so the causes of recessions tend to be political events, whether it's from the federal government or the Fed. That tends to kind of be the trigger of most recessions. So, when you look at something like a trade war, the economy is doing really well right now and has a lot of things going for it. But if you look at it through the context of most recessions are caused by political events, and that's not a partisan statement. I think that goes on both sides. And just thinking what is going to cause the next recession? Could it be something like a trade war? It certainly doesn't help. So you put those two things together, just the high valuations and then the historic triggers of recessions and downfalls. And if I had to think, or if I had to make an explanation for why the market has been choppy lately, it would be that.
So I think with some of our listeners, they have an interest in, I don't want to get too much in exactly how the sausage is made, but I think some of our listeners have an interest in actually knowing how the market works and what is actually happening here when someone buys a stock or sells a stock. And so in these moments of volatility, how I picture it is a bunch of bros on Wall Street yelling, sell, sell, sell. But that's just me and my watching Wall Street movies.
And that was 100% true as recently as 10 years ago. It's completely not true whatsoever anymore. Mm-hmm. If you look at pictures of the New York Stock Exchange today, where it used to be the bros yelling sell, 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 mm-hmm. that today is, it used to have literally, let's say, 1,000 people on the floor. If you go back to the 80s, which was probably the peak of the human trading era, it's probably 1,000 people on the floor of the New York Stock Exchange. You go there today, and it's 20 people, 19 of whom are CNBC anchors. And
Right.
I mean, it's all been digitized now. And so much of it still occurs kind of at the New York Stock Exchange and in buildings in New Jersey and New York, but it's all digitized. And, I think that that doesn't necessarily change the function of markets. Things happen faster than they used to, but I think markets are still fairly efficient right now. You can point to the flash crash in 2010 where the computers went crazy and the market fell 10% or something, whatever. But you also had in 1987, which was still heavily dominated by human traders, the market fell 27% in one day. And that was during an era where it was still human traders, whatnot. So I think the markets are fairly efficient right now, even if it's just a bunch of computers yelling at each other. There's a bunch of crazy stories about kind of the function of markets and how they've evolved over the last year to where it's all computerized trading. And my favorite example is there's 2 office buildings in New Jersey that account for the majority of stock trading in the United States. It's where a lot of hedge funds and high-frequency trading offices house their servers. And so that's where the trading takes place. There are these undescript buildings, unmarked, because they're high security. If you're a terrorist looking to take out the American economy, that's the building you want. But within these servers, high-frequency trading became so competitive that there was a fight for the servers to locate. There's a fight between high-frequency traders to locate their servers closest to the end of the building that was near the cables that exited the building, because they were dealing with such small periods of time. They literally called them picoseconds, which is, I think, a billionth of a second.
Wow. That
they were fighting over. That the amount of time it took for the light to travel through the cable to their server, they would have an advantage if their server was a little bit closer to where the cables came out of the building. So they were fighting for space within the building or where to locate the buildings. That's how competitive it became. And then there were literally companies that they wanted the shortest cable connecting their computer, because if they had a long cable, it would take an extra picosecond for the light to travel through the long cable to reach their server. So they wanted the shortest cables possible. I think that just like sums up the extent to which it's become competitive down to this level of time that is like literally this astronomical period of time that's hard to wrap your head around. But I think for day-to-day investors, for most people listening to this, it doesn't have a big impact. But the structure of the market in terms of how trades are actually executed has changed so much in the last 10 years. But that's true, I think, at the institutional level for hedge funds and mutual funds and whatnot. Most people listening to this, if you are an individual investor and you want to go buy 10 shares of Amazon and you log into your E-Trade account and you want to buy 10 shares of Amazon, there's probably another investor in E-Trade who wants to sell 10 shares of Amazon. And so that trade is quote unquote internalized at E-Trade. It doesn't go to the New York Stock Exchange. It doesn't. E-Trade just takes care of it right there. They have enough customers that they can just swap it right then and there. So for most of your trades, for people listening to this, that's how your trade takes place. It never even leaves your brokerage account. It just takes place within, you're trading with another E-Trade customer or another TD, Ameritrade, or Schwab customer. But the stuff that's taking place, if you want to go buy 1 million shares of Amazon, that's where you have the computers screaming at each other, fighting over picoseconds.
Which is insane. Like as an individual investor, I can't fight over picoseconds, right? So what is your best advice? I have a feeling I know what your best advice is for individual investors, but let's hear it.
I think, well, the way to contextualize this, I think, is back in 2010 when there was the flash crash, which if you weren't investing back then, it was a period where out of the middle of the nowhere, the market fell like 10% and then recovered instantly. It was just this flash crash. And we did a bunch of investigation at the Motley Fool at the time, just a big research report on what happened and how it happened and how it impacted investors. And we set out at the time to find an individual investor who was harmed by the flash crash. And we couldn't find one. We could not find a single person who was actually a victim of this day. The market fell 10% and then rebounded immediately. And who was harmed by that? And the answer was hardly anyone. If you had kind of like a standing stop loss order, you may have been harmed by it. But other than that, this was just something that if you were a long-term investor, or even if you were a short-term investor and you didn't happen to be logged into your brokerage account during this like 5-minute period when this happened, it didn't matter. It wasn't that big a deal. And I think that's true for when you're thinking about high-frequency trading and the function of markets. And even to the extent that the function of markets has increased volatility relative to where it used to be, which some people think, I don't think the evidence is that great for it. But for most investors, the answer is it doesn't matter. It doesn't make much difference to you whatsoever. And even if what's going on behind the scenes are computers fighting over picoseconds, for you, the investor who's going to hold Amazon shares for the next 10 years, it doesn't make any difference whatsoever.
So I remember 3-4 years ago, maybe even longer when you were here at the Motley Fool, we were in the middle of a glorious bull market. We still are. But at the time, even then, like, I don't know, 3, 4, 5 years ago, everyone was like, oh, this has been going on a little bit too long. And I remember you were very honest about how you were building up your cash reserve and you had more on the side. And since then, the market has continued to just go up another bajillion percent. I don't know exactly.
That's roughly right.
It's about right.
It rounds to a bajillion.
Yeah. So I wanted to hear your thoughts kind of looking back on that. And I'm not here to be like, you made the wrong decision.
Oh, that's how it's coming off.
Well, that's how it's coming up.
I'm kidding.
But the point is that this was the decision you made a few years ago. You would have made more money had it been in the market than it wasn't, but okay, fine. How do you look back on some of your decisions and think, no, that was still the right move because I was able to sleep well at night, for example?
So I think there's two things to bring up. One is the strategy for the big cash position is a matrix that when the market falls by X, I'm going to invest Y% of my cash. So if the market falls 10%, I'm going to invest this percentage. If that loss goes to 20%, I'm going to put in more. So during that time, if we go back to say 2015, the market has had 2 10% declines and 1 20% decline. So during that period, I have drawn down portions of that cash. I've been saving more cash as well, which brings to the second point, which is that, and this is how it works for me. I think for a lot, maybe even most investors, they would not agree with this statement. But gets back to the point of like personal finance is more personal than it is finance. My goal for investing has always been not to maximize returns. It's to maximize for how well I sleep at night. And so when I look at the economy and growing for 10 years, which I think just leads to a complacency about the odds of the next recession. Or if you look at a bull market that is now 10 years old, which also leads to, I think, just an overall complacency of the odds that it could have another crash or the fragility that could send it into another crash. I feel totally fine with the amount of cash that I have on hand. And I've invested, I've made 3 big transactions during big periods of volatility, the latest of which was the end of 2018 when the market fell 20%, where I was able to put more cash to work. Would I have earned more if I had a time machine and I can go back and I just invested all of my cash in 2015?
Not taking into account how well you would have slept at night.
Right, which is a big thing. But let's leave that aside. Would I have earned higher returns? Yes, of course. But I think there's too many of those situations as investors to say, if I could go back in time and do X, I would have been better off.
If I go back in time, I would have bought Amazon when I was 16 years old.
We could do this all day. Right?
We could.
But even with that, I have zero regrets about it. But I totally understand. I have this conversation with investors a lot who don't understand that position. And I'm done. I never wanted, I don't see that as a debate, because if it works, if something else works for them, I think that's great. But this is what works for me and my family. So back off.
Morgan Housel digging in, doubling down on his bad decision. No, I don't think that at all. I remember at the time that was a controversial take because everyone here at the Motley Fool is like, you should just be fully invested all the time because the market is always awesome. Well, and even when it's not, it's awesome.
Here's another thing, to wrap this into the personal context of how this is how people make investment decisions, not on a spreadsheet. They make them like at the dinner table, talking with their family about what works. If you go back to 2015, let's say, I had a newborn. My wife wasn't working. We just bought a house. So it was a period in which, if I was looking at my financial life, it would have made a lot of sense to say, I'm not in a position to take as much risk right now as I might in a different portion of my life. So if you are a Motley Fool member who is maybe in their 50s or 60s and their kids are moved out and they have a much more substantial net worth than I did at the time in 2015, then it might make a lot of sense, which I think just gets to the point of there's no one-size-fits-all answer in investing, which is hard to do if you're going on TV or writing an article or doing a podcast where you want to give one-size-fits-all advice because there's a lot of people listening to this and you just want to say, here's what you should do.
And they want to hear, what should I do? Just tell me what to do.
They want to hear the one answer.
Yeah.
But I think the hard answer, but the truthful answer is it depends on who you are. It depends on where you are in life. It depends on what your goals are, your risk tolerance, what your future cash flow needs are going to be. Like, there's so many different variables.
Yeah. All right, well, let's move on from market volatility, because another thing that's been going on lately in the markets is IPOs. Most notably, Uber's, which I hear was a huge failure. Dun, dun, dun. And my response to that is I'm always like, a failure for who? It always depends on who that person is, like your perspective on whether it's a failure or not. So what do you think about the recent IPOs?
I think what's interesting, and this is a big historical anomaly, if you compare a long history of IPOs, is the percentage of companies that are going public in the last few years that are not profitable and basically have no prospects for profits. That is not normal.
Yeah, right.
But the percentage of companies that are in that situation over the last few years is rounds to it's most of them. And you look at companies like Uber or Lyft, which we are investors at a collaborative fund, or Blue Apron or Snap, all these companies that are going public, they don't have any prospects for profitability, and they are just cash incinerators. And I think an important dynamic that's taken place is, in the last decade, the VC and private equity industry has grown enormously. It's now literally trillions of dollars, in which 20 years ago it was a fraction of that, which has made it so that private companies can stay private for longer. So in a different era, if you go back to the 90s, let's say, Uber and Lyft and Airbnb and Palantir and SpaceX, all these companies would have gone public way earlier than they either are today, or some of those companies are not even public yet. They would have gone public years and years ago when they were just out of the garage startup phase. Once they got a little momentum, traditionally that's when you went public. Whereas today, these companies are staying private for a long time, and they're backed by venture capital funds and private equity funds that those type of investors tend to have much more tolerance for losing money, for the companies losing money, for net operating losses at the company level. And therefore, by the time these companies go public, like when Uber goes public, or if it's going to be Airbnb or Lyft or whatnot, these companies are big, established, 10-year-old, deca-billion-dollar companies. But they, in terms of their internal financials, their operating losses, they're looking like brand new startups that are just bleeding money all over the place. And public markets don't have the appetite for that. So it's this really weird dichotomy where you have these companies like Uber that, when they're backed by venture capital funds, look, they're doing great, and VCs will give them all the money they want. And then the moment they become public companies, public investors look at their balance sheet and their income statements and say, what the heck is this?
Right.
This is not a business. you look at something like Uber and Lyft, which I have to keep saying, we're investors in Lyft. So this is not, necessarily a criticism of the investors who've backed these. It's just the reality of where we're at. Every Uber and Lyft ride you take, investors cover a third of the cost of that ride. They just lose money on every single ride.
Wow.
And that is not something that if you went back before the late 1990s would have ever been acceptable.
Yeah.
And I think there's a big difference between a great product and a great business. And a lot of these companies are great products. They're amazing products, but they're not good businesses. That's the reality of it. And if you look back just to contextualize the extent to which that did not used to be true, Michael Dell from Dell Computers posted last year the income statement that he used for when Dell Computer was 1 year old, when he was running it out of his dorm room at the University of Texas, I think it was. This is literally a dorm room company. Not even, he hasn't even graduated to the garage yet.
Yeah.
This is dorm. And he had 20% net profit margins. And the extent, I honestly don't think there's a single well-known startup today that has that.
Yeah.
And that was when he was operating out of his dorm room.
Yeah. But
I think that was expected back then. It was, if you go back to that era, if you had a business, the idea that of course you're going to be profitable, you're not a business unless you're profitable.
Yeah.
And so it's a very different, just kind of expectations today at the VC level. And I don't know if that's a bad thing. I think it's too early to tell whether that's a bad thing, because companies that don't have to focus on quarterly profits these days can focus more on really building out a great product and whatnot. But there has to be some balance on the other side. And when these companies go public, like Uber and Lyft have recently, they realize that other side is completely different than the side in which they've lived in for the previous decade.
Yeah. While I was looking for the Doomsday article headlines today, one of the big ones was that Beyonce was going to make a ton of money off of Uber. Did you see this?
I read this morning.
I only read the headline.
So there's two parts of this.
Okay.
One, and granted, I think the source of this It didn't look like the most reputable source, but it's a good story, so let's run with it.
Yeah, we should absolutely run with it. So I read the headline and I thought, no wonder Uber's not profitable. They offered Beyonce $6 million.
That was my thought too.
Right?
That's what actually made me think that doesn't sound right.
Okay.
That doesn't sound. But let's run with it.
A lesson in reading beyond the headline.
Apparently, Beyonce performed for Uber in I think 2013, and they paid her $6 million, and she opted to take the payment in stock. And that stock is now worth $300 million.
Smart move.
I honestly, I have 50% faith that that's accurate. Mm-hmm. But let's go with it.
Okay.
The other story that I know is accurate is that Beyonce performed at Coachella last year. Mm-hmm. Her fee for that was $8 million.
Jeez, wow.
But she said instead of taking the $8 million, she said, I don't want $8 million. Just give me the rights to the video. I'm going to record this performance.
Oh, okay.
And that's mine.
Yeah.
That's my compensation. She sold those rights to Netflix for $60 million. You hear these stories, and it's these are very smart people.
Yeah, yeah.
It's she declined her $8 million fee and ended up making $60 million off of it.
Yeah, I mean, what's she going to do with another $8 million? Right? I'll make even more off of it.
Amazing. I love the stories of the people who end up making more money from these side businesses than they do from their actual careers. Michael Jordan, made so much more money from Nike than he ever did from basketball. Mm-hmm. Shaq is another person who's made so much money from investing his basketball earnings than he did from basketball. And then you have other people like Jay-Z and Beyonce and whatnot that make a fortune outside of their inherent, their day jobs.
How do I invest in Beyonce? Can I get some equity in Beyonce?
Did she IPO?
She should IPO.
She should go public.
I would totally invest in that because she's very profitable.
Yes. More than all these companies.
All right, Morgan. Well, thank you for joining us again.
Thanks for having me.
If you listeners want more Morgan, and I know you do, head to collaborativefund.com. Morgan is you're a partner at the Collaborative Fund, and you also write for them. Is that accurate to say you're a partner?
Like the Beyonce headline, let's just run with it.
He's there. He's with Collaborative Fund. Head there and you can read all of his articles. Also follow him on Twitter. He gives good Twitter. So there you go. At Morgan Housel. Is that what you are on Twitter?
That's right.
There you go. MorganHousel. Morgan, thanks again.
Thanks for having me.
Well, that's the show. It's edited volatilely by Rick Engdahl. Hey, drop us a line. We're at answers@fool.com. We have a mailbag episode coming up. I believe Emily is going to be joining us again.
I believe so.
So great.
Yeah.
She was great last time. I'm really excited to have her back in the studio. Send us your questions about investing. That's really going to be her sweet spot. I guess Bro can answer your questions about other stuff.
We'll see. See if I feel like it.
Whatever, you have to. Whether you like it or not. This is a ride or die situation on Motley Fool Answers. We are all stuck in this together. All right, well, for Robert Brokamp, I'm Alison Southwick. Stay foolish, everybody.